3 reasons not to be concerned about a stock market crash. With the stock market officially in bear market territory, it's natural to wonder how much worse things can get before we reach rock bottom. Indeed, while 2022 has been a difficult year for the stock market, the worst single day in the S&P 500 this year was only a 4% drop. That doesn't even trigger the circuit breakers on the market, which would halt trade temporarily. While the decline has been painful, it has not been a full-fledged rapid market crash, with all of the ensuing instant wealth destruction. In other words, if the market continues to fall from these levels, things could get worse. Despite that ominous prospect, there are at least 3 reasons not to be concerned about a stock market crash, as long as you're prepared for one. 1. You have a sizable emergency fund in cash. Even if inflation is eroding your money's purchasing power, a market crash can actually wipe out more value in a single day than even today's high inflation rates do in a single year. Furthermore, big market crashes frequently coincide with significant employment losses. An emergency fund can provide you with a much-needed safety net if you lose your job during or shortly after a market crash, or if you experience another disaster while the market is down. Although it won't keep you afloat forever, having a sizable emergency fund, equivalent to 3 to 6 months worth of spending, will buy you some much-needed time. You won't have to sell your investments in the middle of a particularly difficult market if you have that buffer. After all, just because the market is weak or you lost your job doesn't mean that your bills will stop coming in. Having an emergency fund can make all the difference in being able to participate in any market rebound that follows by preventing you from being compelled to sell shares at their lowest prices. 2. You don't have to sell your stocks in order to pay your immediate expenses. If 2022 has taught us anything about investing, it is that stocks can have both ups and downs. This is why you shouldn't invest money that you'll need to spend within the next 5 years or so in equities. Instead, you should keep cash, certificates of deposit, CDs, or high-quality assets with matched durations, such Treasury investment-grade bonds, with the money you know you'll need to spend within that time period. It goes without saying that you won't make much money on such kinds of investments, but there is a lot greater chance that the money will be there when you need it. These assets, much like an emergency fund, can prevent you from needing to sell during a bear market just to cover your expenses. The other advantage this strategy offers you is that it really aids in keeping your composure when the market is collapsing. There is nothing quite like knowing you won't need to use the money you invested in stocks in the coming years to support the long-term thinking required to stay invested while equities are down. 3. You don't make investments using margin. The mere fact that stock prices are declining swiftly won't force you to liquidate your positions as long as you aren't using margin to invest. However, if you are utilizing margin, declining stock prices may result in a margin call, forcing you to sell while your investments are losing value. Your broker has the right to liquidate any position in your account in response to a margin call. Your broker doesn't care about the future potential of your investment, whether you will experience a capital gain or loss, or anything else that is important to you during a margin call. The broker is only concerned with completing the call and releasing you from your obligation. Therefore, a broker-enforced liquidation may prevent you from taking part in any ensuing rebound and may have unfavorable tax repercussions as well. Margin is a true two-edged sword that can also be used by your broker to manipulate the odds in its favor. When you take out a margin loan, your broker not only keeps the interest, but they can also alter the conditions of the margin agreement. Frequently, this entails tightening terms after a stock declines, which may necessitate a margin call or worsen an already existing one. When the market is rising, it can be tempting to utilize margin, but if the market falls, and it will, your losses could rapidly outweigh any gains. All things considered, if you currently fit all 3 of these descriptions, it will be much simpler for you to weather a market downturn. In fact, you may even be able to profit from a downturn by purchasing excellent companies at a discount. However, if you are missing out on one or more of them, there is no better time to prepare yourself. Whether or not the market crashes soon, the reality is that it will crash again. Being ready before it crashes will place you in a far better position than if you wait until you're unprepared. So start making your preparations right away and you might be able to significantly lessen your concern about the state of the market.